When it comes to investing in stocks, one of the most important principles is diversification. But what does it really mean to diversify, and why is it so crucial for investors? In this video, we'll explore the role of diversification in stock investing, breaking down its benefits and how it can help you manage risk. Let's start by understanding the basic idea. Diversification is about spreading your investments across different assets, industries, or geographies to reduce the impact of any single loss. This simple strategy can make a big difference in your investment journey. Imagine putting all your money into just one stock. If that company faces trouble, your entire investment could be at risk. This is called concentration risk. Diversification helps protect you from this scenario by ensuring that your portfolio isn't overly dependent on the performance of a single company or sector. By spreading your investments, you can weather the ups and downs of the market with greater confidence and stability. Diversification is a strategy that involves investing in a variety of assets rather than just one. This could mean owning stocks from different industries, countries, or even different types of investments like bonds and real estate. The goal is to balance your portfolio so that if one investment performs poorly, others may perform better and help offset the loss. This approach is a cornerstone of modern investing and is recommended by financial experts worldwide. Let's look at how diversification works in practice. Suppose you invest in technology, healthcare, and consumer goods stocks. If the tech sector faces a downturn, your healthcare and consumer goods stocks might still perform well, helping to balance out your overall returns. By not relying on a single sector, you reduce the risk of large losses and create a more resilient investment portfolio. There are several ways to diversify your investments. You can diversify by asset class, such as stocks, bonds, and real estate. You can also diversify by industry, investing in companies from different sectors. Geographic diversification means investing in companies from various countries. Each type of diversification helps reduce risk in a unique way, making your portfolio stronger and more adaptable to market changes. Asset class diversification involves spreading your investments across different types of assets, such as stocks, bonds, and real estate. Each asset class reacts differently to market conditions. For example, when stocks are down, bonds might perform better. By holding a mix of asset classes, you can smooth out your returns and reduce the impact of market volatility. Industry diversification means investing in companies from a variety of sectors, such as technology, healthcare, finance, and energy. Different industries often perform differently depending on economic conditions. By spreading your investments across sectors, you can protect your portfolio from downturns in any one industry and take advantage of growth in others. Geographic diversification involves investing in companies from different countries or regions. This helps protect your portfolio from risks specific to one country, such as political instability or economic downturns. By including international stocks, you can benefit from growth in global markets and reduce your exposure to local risks. Correlation measures how different investments move in relation to each other. Ideally, you want assets that don't move in the same direction at the same time. By combining assets with low or negative correlation, you can reduce the overall risk of your portfolio. This is a key reason why diversification is so effective in managing investment risk. Volatility refers to how much the price of an investment fluctuates. Diversification helps reduce the volatility of your overall portfolio because losses in one area can be offset by gains in another. This makes your investment journey smoother and less stressful, especially during turbulent market periods. Over the long term, diversification can help you achieve more consistent returns. While it may not guarantee profits or prevent losses, it does provide a buffer against major setbacks. Investors who diversify are often better positioned to reach their financial goals, even when markets are unpredictable. Some investors think they are diversified just because they own several stocks. However, if those stocks are all in the same industry or region, the portfolio may still be at risk. True diversification means spreading investments across different sectors, asset classes, and geographies. Avoiding this mistake can make your portfolio much more resilient. Common question is, how many stocks do you need to be diversified? While there's no magic number, research suggests that owning 15 to 30 stocks across different industries can provide significant diversification benefits. The key is to ensure that your holdings are not too closely related. Mutual funds are a popular way to achieve diversification, especially for individual investors. These funds pool money from many investors to buy a wide variety of stocks and other assets. By investing in mutual funds, you can gain exposure to a diversified portfolio without having to pick individual stocks yourself. Exchange-traded funds or ETFs are another tool for diversification. Like mutual funds, ETFs hold a basket of assets, but they trade on stock exchanges like individual stocks. ETFs offer flexibility, low costs, and instant diversification, making them a favorite among modern investors. Everyone has a different risk tolerance or comfort level with investment risk. Diversification allows you to tailor your portfolio to match your personal risk profile. By adjusting the mix of assets, you can find the right balance between risk and reward that suits your goals and temperament. Over time, some investments may grow faster than others, causing your portfolio to become unbalanced. Rebalancing means adjusting your holdings to maintain your desired level of diversification. Regular rebalancing helps you stay on track with your investment strategy and manage risk effectively. While diversification offers many benefits, it can also come with costs. Buying and managing multiple investments may lead to higher fees and transaction costs. It's important to balance the benefits of diversification with the costs and consider low-cost options like index funds or ETFs. It's possible to over-diversify, meaning you own so many investments that it becomes hard to manage and doesn't add much extra benefit. Too much diversification can dilute your returns and make your portfolio unnecessarily complex. Focus on quality over quantity to keep your investments effective and manageable. Markets go through cycles of growth and decline. Diversification helps you navigate these cycles by ensuring that your portfolio isn't tied to the fate of a single sector or region. This approach can help you stay invested through ups and downs, increasing your chances of long-term success. Diversification can also help you manage your emotions as an investor. When your portfolio is well diversified, you're less likely to panic during market downturns because you know that not all your investments will be affected in the same way. This emotional stability can lead to better decision-making and improved investment outcomes. Including dividend-paying stocks in your diversified portfolio can provide a steady stream of income, even when markets are volatile. This income can help cushion your portfolio during downturns and provide funds for reinvestment or spending needs. Growth stocks can offer high returns, but they also come with higher risk. By including both growth and value stocks in your portfolio, you can balance the potential for high returns with the stability of more established companies. This mix helps you pursue growth while managing risk. Adding bonds to your stock portfolio can further reduce risk. Bonds often move differently from stocks, providing stability when stock markets are volatile. This combination can help you achieve a smoother ride and protect your investments during market downturns. Investing in international markets can open up new opportunities and reduce your reliance on the performance of your home country's economy. By including foreign stocks and funds, you can access growth in emerging markets and benefit from global economic trends. Alternative assets like real estate, commodities, or private equity can add another layer of diversification to your portfolio. These assets often behave differently from traditional stocks and bonds, providing additional protection against market swings and inflation. Index funds are a simple and cost-effective way to achieve diversification. By tracking a broad market index, these funds give you exposure to hundreds or even thousands of companies, spreading your risk and making investing easier for everyone. A diversified portfolio can also help with tax efficiency. By spreading your investments, you may have more flexibility to manage capital gains and losses, potentially reducing your tax bill. Tax-efficient investing is another benefit of a well-diversified approach. It's important to regularly review your portfolio to ensure it remains diversified. Market movements and changes in your personal situation can affect your diversification needs. By checking in periodically, you can make adjustments and keep your investments aligned with your goals. Sum up, diversification is a powerful tool for managing risk and achieving long-term investment success. By spreading your investments across different assets, industries, and regions, you can reduce the impact of any single setback and build a more resilient portfolio. Remember, the goal isn't to eliminate risk entirely, but to manage it wisely and give yourself the best chance for steady growth over time.